Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm here to bring you a weekly economic review for the week ending April 23rd, 2021. And as usual, I'm joined by our chief economist, Clément Gignac. So good morning, Mr. Gignac.
Good morning.
As is the new tradition, it seems I'll start with an overview of the markets, but I'll hand it over to you to discuss the economic aspects, and then I'll be back with more a deeper look at financial markets. So this week, as you can see, lots of red on the screen. So on both bonds and equities. So interest rates a bit higher, meaning that a pullback of minus 0.15% for the universe index and minus 0.63% for the long index. Year to date, again, we remain in the red. Equities this week, it was heavier for both the TSX and NASDAQ, both down 1.6% on average. The S&P 500 down 1.2%. EFI and emerging markets down a little bit less. As we are recording this on Friday morning, markets are in the red at the open, the green at the open. So we'll see where we end up when the day is said and done. But still, year to date, you were better off to be invested in equities than in bonds. Oil was down 2.7% on the week. The Canadian dollar was flat. Euro was positive versus the US dollar, and the price of gold up about 0.5% on the week. So now for the economy and mostly first COVID, I hand it over to you, Mr. Gignac. Mr. Gignac, your mic is closed.
Sorry about that, and my camera as well. So something we have not changed is that we talk about COVID each time, whatever is Sebastian or myself talking about economy. So yes, COVID. Let's start with the chart on the right side. You can notice that in fact that we have a significant acceleration. Maybe that surprised people, but keep in mind that it's influenced by India. India, 1 billion population, and the current wave is much worse than the previous wave. And that's the reason that overall, if you include all countries, not only developed country, but in fact, emerging countries, we have this record. In fact, in India, we talk about 200,000, above 200,000 per day. Could you figure? Could you believe it? It's significant. On the left side, notice it's mainly driven by US, that UK, it's much less severe than the previous wave. Canada is as severe. We have some acceleration, but we will talk about vaccination later on. But at least it's a different picture if you talk about industrialized countries like US, like UK, or even Europe, compared to emerging countries. So now it's a very severe impact on India. Next slide, we talk about vaccination. It's accelerated. It's a good news. Notice on the left side, Canada now exceeds 25% of the population who has received at least one dose. Notice, of course, Israel is always the number one. It's UK as well, and US accelerate 40%. But notice in Europe, it's no longer single digit. Now it's double digit and accelerate at fast pace. It's encouraging to see this kind of 20% now in Europe. On the right side, it's a daily figure. Okay, it's an average per day. But notice per day, Canada. This is the golden curve, I would say, orange curve if you prefer. It's an acceleration. It's a very fast pace now in not as fast as US, but almost as fast. So it's very impressive now, the vaccination per day. So don't be surprised that Canada will catch up on other countries like US very soon. Next slide, we will talk about federal budget. It was the first budget of Madame Freeland, okay, and it was very encouraging. So you can notice they have stimulated the economy. We find interesting from CIBC that chart. Notice US on the left side and Canada the second chart. Not the second chart, but in the first chart, the second part of the first chart. Sorry about that. Notice last year, 2020, whatever is US, Canada, they stimulate as much. 15, 16% of GDP was record deficit. But this year, with the Biden stimulus, it's more impressive than Canada. So the deficit for this year expected in US 15%, 16% GDP compared to 6.5% in Canada. So yes, Madame Freeland has inject 100 additional billion dollars, but they have nothing for provinces. But if you compare, it's less impressive than US is. I found that interesting. As far as the debt people are concerned, keep in mind that Canada, we have the debt has increased from 30% to 50% GDP. 50% GDP is still the lowest in the G7. But if you go with the debt service and the second chart, this is the debt service. Compare in percentage GDP, if compare apple to apple, country by country, if we express in percentage GDP, we are able to compare. And Canada is only 1% of GDP compared to 2.5% in US, for example, and 2% in UK. So I found that interesting as well. So the message is this one. Yes, it's a huge deficit, but if you compare, Canada is still in business and in much better shape, I will say, than other countries. So it's a zone for comfort for me. They have an impact on Bank of Canada. Notice on the next slide, they have changed their tone. They now expect 6.5% GDP growth this year. In fact, a little bit more about that. And if you compare, they no longer see the output gap until 2023. Now, summer 2022, the output gap will be closed. Very, very encouraging. So the tone has changed, and that's the reason the Canadian dollar has reacted positively. Make no mistake, no rate increase anytime soon, but nonetheless, the tone has changed, and the taper on the quantitative easing now is the purchases would be 3 billion a week compared to 4 billion a week of government bonds purchases. So we start to see a tapering on the QE. And next slide is about inflation. Notice the year-over-year comparisons, the total CPI has accelerated, but if you go with the core, it's still very under control. So it's encouraging. But Sebastian and myself believe that the inflationary pressure will build nonetheless during the coming year with what's going on commodities, not to mention the supply chain as well. And that's the reason we see that the inflation, whatever is the core, the total will probably exceed, in fact, 2% year over year by year end. So that's it for me. I was a little bit long. Back to you, Sebastian.
Well, thank you for that. So, yes, we do have some strong links between what you just said on the economy and the financial markets this week, because the idea is how are they in the US going to pay for all of this debt, for all of this deficit following COVID? So, we're starting to see some answers. So, the capital gains tax should be risen in the US, pretty much double for the wealthier part of the population. So that's one part. They're also talking about taxing corporates, so companies a bit more. So raise the corporate tax rate. Now let's just focus on this one here because this is what was the market mover this week. So as you can see on the right, a chart from Stratagas, it's not clear the relationship between the capital gains tax and the valuation of the market, so the P ratio, meaning how much people are willing to pay to own US equities. But what we do see is that usually when the capital gains tax rate rises, well, that tends to give a bit of a headwind for a few years on the US stock market. But as you can see, the relationship is not quite clear. So will this time be different? Meaning, will this time the market keep on grinding higher? Maybe, but probably we should expect a bit of a headwind. And it's interesting because we have mentioned many times in the last few weeks and months that we favor ex-US equities right now. So we do hold some US equities. We're neutral or slightly underweight depending on the mandates, and we are overweight around the US market, so Canada, Europe, emerging markets. So in the US, so this is taxing US citizens. So in the US, you know that American citizens tend to own a lot of US equities. So if they favor less the US market, maybe we could see an outperformance around in other regions. So we'll see how it plays out. But this is one of the first shoes to drop on how to pay for this deficit. One of the questions we get asked a lot is, well, market vulnerable now because there seems to be so much optimism out there, and there is a lot of optimism. On the left, this is the AAII U.S. Investor Sentiment Index, so the bull minus bear spread of this survey. So as you can see, it's pretty much as optimistic as in late 2017. 2018 was actually pretty good all the way until December, and then we had some strong pullback in late 2018. So it's not because sentiment is very bullish that the market is necessarily stretched, but still it is a headwind if you have a long-term horizon. But on the right, one point we want to make is the breadth. So the percentage of stocks that are trading at a strong level now is very elevated, and usually this does not happen at tops. So when you have a top that's forming, you have a deterioration of this breadth before, and then that means the market is more vulnerable. That means it's only a few names that's holding the market together, and it's vulnerable to a crash. Now it means that the average stock is doing pretty well, so the market is held by pretty much all cylinders now. So a lot of breadth in the market tends to be actually pretty good for moving forward for at least short term for market performance. One thing that we are seeing now is that when you ask managers, so the fund manager survey here, as you can see, the dark blue line is the answer to the question. So what are your expectations on growth and inflation? And investors are expecting above trend growth and above trend inflation. So this is what people are seeing now. So unless you have inflation getting out of control, this tends to be bullish for equities, but mostly bullish for value stocks and for cyclicals. So when you talk about value and cyclicals, well, you cannot avoid here the TSX on the left, emerging markets on the right, also Europe, IFI is part of that. But if you focus just on TSX and emerging markets on the left, what you see, this is the foreign investments in Canadian equity. So foreign investors are actually currently buying Canadian stocks. If you remember, 2016 was a very strong year for the TSX, 22% return, if I remember correctly, strongly beating other markets. And that was because we had favorable conditions and foreign investors plunged into. So when they became bargain shopping here in Canada, we could see something like that in 2021. We were expecting something like that. So that's bullish for the TSX. On the right, you see the emerging market index is a mix of many countries. The names that you see below the horizontal line on the right-hand chart. So Turkey, Brazil, South Africa, Malaysia, Mexico, and Philippines. These markets are cheap now when you compare them to the average multiple of the last 10 years. So you have some good bargains to shop there too. So we do still recommend, and this is what we do in our portfolios, overweight equities, but spread it around the world, neutral to slightly underweight in the US. So what to watch next week in Canada? Retail sales and GDP growth. GDP growth for February, well, we'll get. So we'll see how the momentum continued after a very strong print in January. In the US, durable goods orders. We'll have the Fed rate decision. We don't really expect any change policy, but maybe to the messaging. That's next Wednesday at 2 p.m. So follow that. GDP growth for Q1, 6.1% is the consensus. And personal income, no, that's not a typo, 20% in March compared to February because those big checks from the last stimulus package hit the bank accounts. So that's a very strong tailwind here for the US consumer. So Mr. Gignac unfortunately had to leave us mid-recording because of other obligations on his agenda. But here you can always follow us at ia.ca/economy. You can always write at economics@ia.ca, especially if you want to get the PDF copy of this presentation, or subscribe to our newsletter by entering your email in the blue box that you see here on the screen. So thank you everyone for following us every week. We will be back next week, next Friday, with another edition of the weekly economic review.